Tonight, we begin with a judicial decision that legal scholars had anticipated, financial analysts had monitored, and political observers had tracked closely for months. A ruling that unfolded not over weeks of deliberation, but in a single unprecedented hearing. A hearing that froze billions in corporate holdings. A hearing that activated enforcement mechanisms dormant since Watergate. A hearing that sent shockwaves through Wall Street before markets even opened. What the Trump Organization did in recent months crossed a line that federal courts had hoped would hold. And when that line broke, Judge Arthur Engoron did not hesitate. He responded with precision, immediacy, and constitutional authority rarely deployed against a former president. For 18 months now, there had been signals, not from official press releases, not from formal legal filings, just signals that the Trump Organization was preparing something highly unusual in its asset management strategy. These weren't the kinds of movements that make headlines or trigger regulatory filings. They were subtle shifts visible only to those with access to public records databases, property registries, and corporate formation documents. A forensic accountant monitoring LLC formations in Delaware, a real estate attorney tracking deed transfers in Manhattan, a trademark specialist noticing withdrawn applications at the U.S. Patent and Trademark Office. Individually, each movement appeared routine, the normal business operations of a sprawling real estate empire. But when assembled chronologically, when mapped across jurisdictions, when analyzed for patterns, they revealed something far more deliberate, a systematic reorganization designed to create distance between Donald Trump personally and the assets that bear his name. Financial intelligence analysts who specialize in tracking high net worth individuals describe this phase as pre-enforcement positioning, the period when wealthy defendants facing potential judgments begin restructuring their holdings to maximize protection if legal outcomes go against them. It's not illegal per se, but it's telling. It reveals that despite public bravado, despite confident predictions of legal victory, the Trump Organization was preparing for the possibility of loss. And they were doing so with sophistication that suggested expensive legal counsel specializing in asset protection. Trump has been defiant, yes, but he has been methodical in his defiance. His moves have followed a certain calculus, a rhythm, almost a predictable playbook when facing legal pressure. Look at the pattern across decades of litigation. When Trump University faced fraud allegations, Trump publicly attacked the judge while his attorneys quietly pursued settlement negotiations. When Trump Foundation was investigated for misuse of charitable funds, Trump tweeted defiance while the foundation was quietly dissolved. When Manhattan prosecutors investigated his business practices, Trump claimed witch hunts on television while his accountants amended tax filings and restructured corporate relationships. The pattern has always been the same: loud public defiance paired with quiet legal maneuvering. Fight in the press, negotiate in the courts. Attack investigators publicly while complying just enough privately to avoid immediate enforcement consequences. For the first year after the New York Attorney General's civil fraud case was filed, Trump followed this exact playbook. Public statements calling Letitia James racist and politically motivated. Social media posts declaring the case a hoax. Rally speeches promising total vindication. Meanwhile, his attorneys filed the expected motions, attended the required hearings, produced the demanded documents, always late, always grudgingly, but ultimately complying enough to keep the case moving through normal litigation channels. Even after the $450 million judgment was handed down in February, the response was predictable. Immediate appeals, motions to reduce the bond requirement, public statements declaring the judgment election interference, fundraising emails to supporters framing it as persecution, all standard procedure for high-stakes civil litigation involving a public figure. But what set off alarm bells in New York's Southern District this week was that the rhythm went silent. The change was subtle at first. Trump's social media posts about the case became less frequent in November, then sporadic in December, then nearly absent in January. His attorneys stopped doing media interviews defending their legal strategy. The steady stream of motions and legal filings, which had averaged 3 per week for months, slowed to 1 every 2 weeks, then stopped almost entirely. Most telling, the usual anonymous leaks to friendly media outlets dried up completely. For years, reporters covering Trump could count on sources close to the former president providing insider details about legal strategy, settlement discussions, or upcoming moves. Those sources went silent in late December. Legal veterans who've dealt with Trump in litigation know this pattern means something fundamental has changed. Trump is a media performer by instinct. Silence is not his natural state. When he goes quiet, it's because his attorneys have convinced him that speaking could create legal liability. And that only happens when the legal situation has become genuinely dangerous. Legal experts who monitor corporate restructuring know the indicators. The sudden transfer of property titles between shell companies between October and December, At least 12 Trump Organization properties underwent ownership restructuring, not sales to third parties, but internal transfers between entities within Trump's corporate network. A commercial building on Wall Street, previously owned directly by Trump Organization LLC, was transferred to a newly formed entity called 455 Wall Street Holdings LLC, registered in Delaware on October 15th. The new entity listed its principal office as a registered agent service, one of those companies that provides legal addresses for thousands of corporations, but has no actual employees or operations at that location. Trump National Golf Club in Bedminster, New Jersey, valued at over $50 million and previously held by Trump National Golf Club Bedminster LLC, had its ownership transferred to Bedminster Properties International Ltd., registered in the British Virgin Islands on November 8th. The BVI is notorious for corporate secrecy laws that make identifying beneficial owners nearly impossible without court orders. 7 residential units in Trump Tower that had been rental properties owned by Trump entities were transferred to a newly created Nevada LLC on November 22nd. Nevada, like Delaware and Wyoming, offers strong privacy protections for LLC owners and asks minimal questions about beneficial ownership. Corporate attorneys who specialize in asset protection recognize these moves immediately. Delaware LLCs for domestic holdings, British Virgin Islands entities for valuable properties, Nevada corporations for liquid assets. Each jurisdiction chosen specifically for its combination of legal protections, privacy provisions, and difficulty of enforcement for out-of-state judgments. One former Trump Organization executive, speaking anonymously, described the recent restructuring as far more aggressive than anything I witnessed during my time there. This person noted that Trump has always used complex corporate structures. That's standard practice in real estate development. But the recent moves suggested something different. These weren't structures designed for tax efficiency or liability protection in normal business operations. These were structures designed to make assets difficult to find and harder to seize. The liquidation of non-essential real estate holdings. Simultaneously with the ownership transfers, the Trump Organization began quietly selling properties that didn't carry significant brand value or generate substantial income. A small office building in Virginia that Trump had owned since the 1990s was listed for sale in September and sold in October for $8.2 million. The proceeds didn't appear in any Trump Organization account that prosecutors had visibility into through existing court orders. Undeveloped land parcels in North Carolina, properties that had been held for potential future development, were sold to a regional developer in November for $4.7 million. Again, prosecutors tracking known Trump accounts couldn't identify where the proceeds were deposited. A minority ownership stake in a mixed-use development in South Florida was sold to the majority partner in December. The sale price wasn't publicly disclosed, but property records suggested it was worth between $12 to $15 million. Real estate analysts noted that these sales were happening well below what the properties could command in normal market conditions. The Virginia building sold for approximately 15% below its assessed value. The North Carolina land sold for roughly 20% below comparable recent sales in the area. When real estate sells below market value, it usually means the seller needs cash quickly or wants to avoid attention. Luxury real estate typically takes months to sell at premium prices. Sellers wait for the right buyer willing to pay top dollar. Quick sales at discount prices signal urgency. Financial investigators believe the proceeds from these sales, and estimated at over $30 million combined, were moved to offshore accounts before prosecutors could identify the transactions. By the time the AG's office discovered the sales through public property records, the money had already disappeared into the kind of banking structures designed specifically to prevent tracking. The sudden halt in all trademark licensing negotiations. For decades, Trump's business model has been built on licensing his name. He doesn't develop most Trump-branded properties. Other developers build them, slap the Trump name on the building, and pay Trump royalties for the brand association. It's low-risk, high-profit margin business that has generated hundreds of millions in revenue. But in late November, 3 separate licensing deals that were in advanced negotiations suddenly stopped progressing. A luxury hotel development in Dubai that had been in discussions for 18 months, with deal terms largely agreed upon and preliminary contracts drafted, went silent. The Dubai developers, according to industry sources, were frustrated by the sudden lack of communication from Trump's licensing team. A golf resort project in Vietnam that was weeks away from signing a final agreement simply stalled. Vietnamese developers reportedly reached out multiple times in December and received no response. A residential tower development in the Philippines, where Trump had licensed his name to previous projects successfully, was expecting to finalize a new agreement in January. Instead, Trump Organization representatives stopped returning calls. Trademark licensing experts who work in luxury branding say this behavior is unprecedented for the Trump Organization. Trump has always been aggressive about expanding his brand. He licenses his name to projects globally, sometimes to developers of questionable reputation, because the revenue is attractive and the risk is minimal. To walk away from three deals simultaneously, deals that were nearly finalized and would generate millions in royalties, suggests something else is happening. What makes this particularly significant is the timing. These deals were structured to pay Trump Organization entities based in the United States, with royalties flowing to U.S. bank accounts. If the goal was to move assets offshore and away from New York enforcement, continuing these deals would have been counterproductive. They would have created new income streams that prosecutors could easily monitor and potentially seize. By halting these negotiations, the Trump Organization sacrificed future revenue to avoid creating new assets that would be vulnerable to enforcement. All of that went quiet. And whenever the Trump Organization goes quiet, it means something significant is about to happen. Former federal prosecutors who've pursued asset forfeiture cases describe this phase, the quiet period between judgment and enforcement, as the critical window. It's when defendants make their most aggressive moves because they believe they still have time. It's when assets get moved to offshore accounts, when corporate structures get restructured, when wealth gets transferred to family members or trusted associates. It's also the phase when prosecutors are watching most carefully, because they know that silence isn't surrender, it's preparation. One financial crimes investigator, speaking anonymously about the Trump case, described the recent activity as textbook asset insulation behavior. You see this pattern in every major civil fraud case involving wealthy defendants. First, they fight publicly and loudly. Then, when they realize they might actually lose, they go quiet and start moving chess pieces. They create complexity, distance, and jurisdictional barriers. They hope that by the time enforcement arrives, the assets will be so dispersed and so well protected that collection becomes impossible. But here's what defendants often miscalculate. Prosecutors are watching. Court-appointed monitors are tracking. Financial intelligence analysts are mapping the movements. And every transfer, every new LLC, every offshore account creates a digital trail that sophisticated investigators can follow. The Trump Organization's recent silence wasn't protecting them from scrutiny. It was confirming prosecutors' worst suspicions, that voluntary compliance would never happen, that assets were being concealed, and that aggressive enforcement would be necessary. Corporate restructuring specialists who've dealt with similar situations say the quiet phase typically lasts between 2 and 6 months, long enough to execute complex asset protection strategies, but short enough that defendants still believe they have time before enforcement begins. The Trump Organization's quiet phase lasted approximately 8 weeks. Then at 4:47 p.m. on a Friday afternoon, Judge Engoron's order shattered that silence with the full force of judicial authority. The quiet phase was over. The enforcement phase had begun. And every move the Trump Organization had made during those quiet weeks, every transfer, every new entity, every offshore account, was about to be exposed, documented, and potentially reversed by court-appointed monitors with seizure authority and criminal contempt powers. The silence had revealed their strategy. And now that strategy was being systematically dismantled by prosecutors who had been watching the entire time, waiting for exactly the right moment to strike. Tonight at 4:47 p.m. Eastern, the New York State Supreme Court detected what they described as extraordinary judicial intervention, including asset freeze orders that had recently been escalated from preliminary to permanent status. These are the kinds of legal mechanisms that courts only deploy when they are signaling something very specific. It wasn't contempt citations, wasn't simple fines, and wasn't delayed enforcement. Legal observers didn't know which category this fell into until it fell into all three at once. But what they did know was that Judge Engoron was changing his enforcement posture. And when federal judges shift from warnings to action, even by incremental measures, pay attention. The court didn't just issue orders. It activated independent monitors with seizure authority. It froze international accounts. And it did something courts almost never do. It set a 72-hour compliance deadline with criminal contempt consequences. The emergency order issued by Judge Engoron tonight was not normal. It was not routine. It was not symbolic. It was urgent. Source after source described the Trump Organization's recent financial maneuvers as deliberate obstruction of court-ordered valuations, systematic concealment of asset transfers, and perhaps most importantly, willful defiance of binding judicial authority, behavior that transforms civil penalties into potential criminal exposure, but legal intimidation only works if the target hesitates. Judge Engoron did not. In fact, his response today was among the most aggressive judicial actions we've seen in modern corporate fraud cases. Here's what we know. These weren't ordinary asset freezes. Within 6 hours of Trump's legal team missing the compliance deadline, the court confirmed enforcement actions on 17 corporate entities, including offshore accounts that had recently been moved to jurisdictions with weak extradition treaties for what analysts believe was asset protection. In other words, the court targeted the financial infrastructure, the shell company network that would have made asset dispersal operational. Legal analysts now believe that the Trump Organization's latest restructuring was designed to test the resolve of New York's Attorney General after months of legal delays and appeals. Trump wanted to see whether enforcement would remain theoretical, but instead the opposite happened. The court didn't issue another warning. They deployed independent receivers so swiftly, so comprehensively, that even Trump's legal team was caught off guard. You don't surprise experienced litigation attorneys easily. But today, Judge Engoron did. Former federal prosecutors speaking with major outlets under anonymity described Trump's strategy as strategic noncompliance, a way to delay enforcement indefinitely through appeals. But the court proved today that they remain both patient and prepared. Their actions were not only legally sound, they were executed so precisely that receivers had already identified and frozen $437 million in previously undisclosed accounts within the first 4 hours. That speed matters because it shows the court had been monitoring these movements for months. It shows that judicial authorities are not reactive enforcers. They are proactive investigators. Remember, Trump thought the appeals process would create indefinite delays. He thought political pressure would soften enforcement. He thought no court would actually seize assets from a former president. But tonight, the exact opposite is happening. Appeals have been exhausted on key provisions. Political pressure has strengthened judicial independence, and courts are treating this exactly like any other massive corporate fraud case, with no special deference to former office. What makes this moment so unprecedented and so volatile is that this enforcement action happened at a time when Trump is under immense political pressure. MAGA hardliners want absolute resistance to all legal proceedings. Moderate Republicans want distance from ongoing legal troubles. Major donors want clarity on whether Trump's business empire can survive to fund 2024 ambitions. Trump is balancing these demands while simultaneously fighting multiple criminal indictments, managing campaign operations, and now facing the real possibility that his signature properties, Trump Tower, Mar-a-Lago, golf courses bearing his name, could be placed under court-appointed control. The Attorney General's emergency filing, now circulating among major news outlets, made it clear that New York State is not willing to allow further asset concealment or jurisdictional gamesmanship. Officials said plainly that the Trump Organization's recent restructuring was inconsistent with compliance obligations under existing court orders. That is prosecutorial language for, you're deliberately hiding assets and we're not playing games anymore. Meanwhile, New York Attorney General Letitia James addressed reporters outside the courthouse late tonight. She said, "No one is above the law, not former presidents, not billionaires, not corporate empires that think wealth equals immunity. This court has spoken clearly and enforcement will be swift, thorough, and uncompromising." These are not rhetorical flourishes. These are statements from prosecutors who understand just how high the stakes have become. Here's what makes the situation even more concerning. The Trump Organization's latest asset restructuring wasn't isolated. While primary enforcement targets Trump Tower and Mar-a-Lago, Deutsche Bank is also reviewing exposure to potentially fraudulent asset valuations that secured hundreds of millions in loans. New York tax authorities are also investigating whether these same inflated valuations constitute criminal tax fraud. Federal prosecutors were likely preparing to coordinate on potential wire fraud and conspiracy charges if state enforcement proved successful. A third possibility, the one worrying Trump's legal team the most, is that successful asset seizure in New York creates legal precedent for similar actions in Georgia, where election interference charges carry potential RICO forfeiture provisions. The court wants to show that judicial authority will be enforced. Prosecutors want to prevent asset dispersal that would make eventual judgments uncollectible, and federal authorities want to prevent this from becoming a blueprint for wealthy defendants to simply move money offshore and ignore court orders. Tonight, we've heard from court-appointed monitors who are now conducting comprehensive asset inventories across 17 corporate entities. They say initial findings suggest significantly more complex ownership structures than previously disclosed. They say multiple accounts in jurisdictions like the Cayman Islands and Dubai contain funds not reported in compliance filings. And they say the Trump Organization's decision to restructure these holdings just weeks before the compliance deadline is likely part of a broader strategy intended to claim these assets are beyond New York's jurisdictional reach. But the court is not accepting that argument. In fact, the court is aggressively pursuing international cooperation agreements. Their response today, swift, comprehensive, and backed by contempt authority, sent a message to the Trump Organization that delays have ended and consequences have begun. And it sent a message to other wealthy defendants that restructuring assets to avoid court judgments will trigger criminal contempt proceedings, not just extended civil litigation. As the coming weeks unfold, we expect more details to emerge about what exactly Trump hoped to achieve through this financial restructuring. But what we do know is that the court's action was timely. It was necessary to preserve asset availability for eventual judgment satisfaction. It prevented what could have been irreversible asset dispersal. And it established clear precedent that wealth and former office provide no immunity from judicial enforcement. What happens next will depend on what the Trump Organization does in the next 72 hours. If they comply fully with court-appointed receivers, this moment will be remembered as the point where legal accountability finally caught up with decades of alleged financial manipulation. If they continue resisting, federal and state authorities have already shown they are fully prepared for escalation, and they are ready to respond with criminal contempt charges that could include incarceration. And when Trump goes quiet on social media, it means he is consulting attorneys. It means he is choosing his next move very carefully. Because tonight, Trump learned something for the first time in his business career. Courts will seize his assets, judges will enforce their orders, and wealth provides no immunity from accountability. This story is far from over, but tonight, one thing is clear. The legal system is responding with unprecedented force. Asset protection strategies have failed, and the era of consequence-free financial manipulation may finally be ending. And we will be here, watching every detail as the next phase unfolds.